take on the case
Yeah.
study?
So we have a case study here to show you the value proposition of doing an oil and gas compared to nothing. So we have married filing jointly, living in New York, making 600K in earned income. Now, if they don't do anything else, assuming they're in 50% marginal tax rate, they would owe $300,000 in taxes. They have a clock on it till December 31st to do something about it, or they're going to write the money check to Uncle Sam. Comparison to that, they go and put 200K into oil and gas, where they are able to get around 180K, 150, 185K worth of deduction against your AGI, which means they're gonna first they're claiming tax savings. So if it's $180,000 for the sake of round numbers, they're able to write off $90,000 worth of taxes. That's one. And they're gonna fall in lower marginal tax rate. That's another one. Now you got the deduction, and then useful based on the cash flows. There is an income upside to it. So based on historical numbers and 8% growth rate that we are assuming, if you put 200K in oil and gas over the length of 14, 15 years, we use conservative numbers. We just don't want to inflate the numbers here. So over the course of 14 to 15 years, you are looking at around $500,000 worth of tax savings and the cash flow that's coming out of it. In comparison to if you would have paid the taxes and reinvested the money with the same growth rate. And the case study, the number, the 499 that you're looking at, it's based on the historical cash flows that we have gotten from our partners. But it's all, the way to think about it is a portion of it, you owe that money to IRS. Either you do something about it, or you're gonna write it anyway. So I know we're on the time, Jeff. I'm not sure how much
No,
time we
no,
have.
that's great. And just to drive this home, this is not sensitive really to the growth rate, because we're assuming either that you're taking your money, paying your taxes, and then investing, or that you're doing oil and gas, getting the tax savings, investing that, and then reinvesting the income after taxes from the oil and gas every year. And so if you got a higher growth rate than 8% historically, or even if you got a lower growth rate, the ordering, the benefit of oil and gas would still be positive. The bigger your return, the bigger the benefit.
And, and like any other strategy that we offer, where we have calculators on all the strategies that we offer, and that's why we have a calculator for oil and gas as well. Whatever you think is the reasonable growth rate based on your risk appetite, you could just put in there to see how the numbers fluctuate on your end. Gita, if you can drop the link again for a calculator, I've been asked this again, but yeah.
Yeah. And by the way, just to kind of think through the implications of this, as I said, there's really, assuming historical returns from oil and gas, there's no world where it underperforms as compared to just paying your taxes. And this, by the way, is all these numbers are after tax and after fees. So it's going to be a significant boon, assuming that the historical numbers are right or that we outperform, which is a question.
And
Um, yeah, no, go on.
one thing to add here is that usually funds offer what is called a preferred return. So depending on the time of the year that you're doing, but you usually have a preferred return around 12, 14, 15% for certain years. So the fund is suppose making 20% of the profits. You will have suppose 15%, 14% preferred return for suppose 5 years, which means the fund is not going to make anything unless you make 14% a year, which means over the course of 5 years, you're making 70%. So you're going to make 70% over the course of 5 years before fund is going to start making anything.
Yeah.
I know we have talked about historical numbers and how aggressive that is, but that is in place, and they are confident about the fact that they're going to make enough. So they'll make profits on top of it. We can go in depth, but
No, but that's a good insight, Farhan. The fund sets their own terms, and they've decided that they are confident that they're going to get more than 14% a year over the first 5 years, so that they're going to be making money. They wouldn't have set that number there if they didn't expect to beat it.